Let's get right over now to our next guest. Matthew Johnson's with us, president, owner of Johnson Wealth and Income Management, to give us your big picture here. I mean, honestly, when you take a look, people got excited today. They saw some up arrows. The Dow's been down 5 weeks in a row. Today it was up over 450 points. I think people started to get they like to see some green for their 401ks and IRAs, but this volatility is tough for investors. You expect it to continue, I'm sure?
Well, thank you for having me. It's good to be back on. And yes, I do. I expect that there's going to continue to be volatility in the market. You know, we have a pretty broad array of all sorts of uncertainties that are hitting us from all different points, right? Whether it's what the Federal Reserve does, whether or not the peace talks between Russia and Ukraine are going to, actually come to some reasonable agreement so that we can start to see some peace. What's going to happen to oil prices? Are they going to continue to abate, or are they going to just be short-lived and all of a sudden they're going to spike back up? There is just a tremendous amount of uncertainties that people are having to deal with, and investors in general.
And so when you look at that overall, right, and the volatility, what do you make of it when the Fed has to decide what to do? Because we have this inflation we haven't seen in 4 decades, basically, right? And they're sort of caught because they need to make some moves, but at the same time, we're seeing a slowdown already.
Well, that's absolutely true. Energy prices going higher is a tax on everyone, right? So as a result, I think the rationale is going to be that the Feds are indeed going to have to continue to stay on track to some extent with their rate increases. Although they may just do that a little bit more slowly. They may not increase it as often. We had heard earlier that they were going to do as many as, say, 7 rate increases. I think that would be excessive. It definitely would throw us into a recession, and they don't want that. They want to keep the economic car on the rails and continue to just slowly abate this inflation. But with that being said, this kind of goes back to one of the basic principles of investing, Nicole. We have to make certain that we are well diversified. Individuals that have all of their money in one asset class, or they're sitting all in cash, or they're sitting all in precious metals, or they're sitting all in stocks, that's a good way to get a good shellacking anytime the market decides to move in a direction that's contrary to what you think it's going to do. So we can't underemphasize good old-fashioned diversification. I teach my clients that during volatile moves, you don't know what's going to bring the volatility. You don't know how long that volatility is going to last. We know that all conflicts end, right? Every single conflict ends. It finally comes to an end. But how long is it going to take before it ends? And so because we don't know the answers to these things, we have to work diligently to make certain that if we're going to have some money, say, sitting in stocks, I teach my clients as a fiduciary, I want you to be, if you're going to be taking on that risk, I want you to get rewarded for the risk. I want you to be in things that are going to pay you a dividend.
Right.
The dividend is going to be there for you to spend. When we're in a high inflationary environment and it's costing us, $4.20 a gallon for gasoline, having an increase in your stock portfolio is nice. That makes you smile, but you can't spend that, right? But you can spend dividends, you can spend interest. Paying attention to all of the discounts that have already been, to some extent realized within the fixed income market, and realizing that as the Feds continue to raise these interest rates, as I believe that they will do, those Kmart blue light specials are going to continue to be there. We're going to be able to use that math to our advantage. So diversification at the end of the day is absolutely so important. I believe it was Spanish philosopher George Santayana that said, if we don't know history, we're destined to repeat it. But then you've got Baron Rothschild that says something to the effect of, buy when there's blood in the streets. We have to look at all of the volatility and realize, yes, it is scary, but if we are well diversified, right, that helps tremendously. And it also gives us an opportunity, if we have some cash sitting on the sidelines, to be able to buy these dips. And within the fixed income market, the math doesn't lie.
Is there anything you would avoid quickly?
I do believe in being diversified outside of investment products. So in other words, I believe in investing in individual bonds. I believe in investing in individual stocks. That being said, as these rates go up, bond funds have taken a tremendous beating, and I believe that the headwind that they have faced is going to continue to stiffen. So I would definitely be out of bond funds, because you have to sell shares to get income. Why not just actually own the bond the right way, and that way you get paid 100% of the income?
Yeah, understood. Great to see you, Matthew. Thank you. Matthew Johnson, Johnson Wealth and Income Management. Thank you. Good conversation, and obviously some real concerns. Stay diversified, get some dividends. Makes sense. Thanks, Matthew.